Hello, I'm Bob Vensko, President of Regal Home Lending. Today we're going to discuss the Federal Reserve's surprise 50 basis point rate cut on March 3rd this week. The number one question that I'm currently receiving from my clients is, hey, I heard that the Fed's cut rates. Does that mean that my mortgage rate will now be 0.5% lower? Well, the short answer is no. The Federal Reserve does not make consumer mortgage rates. Mortgage rates are derived from Wall Street. The Federal Reserve has no direct connection to the U.S. mortgage rates whatsoever. Don't believe me? Here's the proof. As you can see, the Fed funds rate and the average 30-year fixed rate have differed by as much as 5.25% and as little as 0.5%. The green areas represent the 30-year fixed rates, while the blue area represents the Federal Reserve's funds rate. There's no correlation. After the Federal Open Market Committee, FOMC, has scheduled their meetings, they issue a press release to the public, which highlights the group's economic opinions and consensus. When the FOMC's post-meeting press release is generally positive on the U.S. economy, mortgage rates tend to rise. Conversely, when the FOMC is generally negative with its outlook, such as a global pandemic, mortgage rates tend to fall. The Fed doesn't control mortgage rates, but the connection between inflation and mortgage rates is direct. High inflation in the early 1980s led to the highest mortgage rates ever. 30-year fixed mortgage rates went for over 17%, as an entire generation of borrowers will certainly remind you. Inflation is an economic term describing the loss of purchasing power. When inflation is present within an economy, more of the same currency is required to purchase the same number of goods. Mortgage rates are based on the price of mortgage-backed securities, and mortgage-backed securities are US dollar denominated. This means that a devaluation in the US dollar will result in devaluation of US mortgage-backed securities as well. When inflation is present in the economy, then the value of a mortgage bond drops, which leads to higher mortgage rates. This is why the Fed's comments on inflation are closely watched by Wall Street. The more inflationary pressures that the Fed puts on the economy, the more likely it is that mortgage rates will rise. So where will you feel the Fed's rate cut? Home equity lines of credit, consumer credit cards, and auto loans are typically linked to the prime rate, and as a result, they will adjust relatively quickly to the lower Fed's funds rate. The stock market also loves cheap money. When businesses can borrow more money at a lower cost, they can expand their profits as a result. Thanks for joining me. This has been another market update with Bob Vensko, President of Regal Home Lending.